we looked at in chapter 1 that had the different ways of doing an income statement and balance sheet. Remember that? Retail, services, and manufacturing. Remember the three? Which is this likely to fit in? Services. Would this company likely have a balance sheet in your view? No, services likely would not have a balance sheet. Therefore, this would be strictly, for all intents and purposes, an income statement business. Let's move on. Maya Doyle, senior partner of the agency, recently attended a workshop at the local university in which the balance scorecard was presented as a way of focusing all of the company's functions on its mission. After the workshop, she met with her managers in a weekend brainstorming session. The group determined that Houseke's mission was to provide high-quality, innovative risk protection services to individuals and businesses. So to ensure that the agency would fulfill its mission, the group established the following objectives. Now you know from sitting up here that we're going to have one objective for each one of the quadrants, right? We know that. But we could have a lot of performance measures, and that can be the reality when you build a balanced scorecard. So in the financial perspective, which did you pick as the objective?
Increasing sales.
Just curious, which ones did you pick for the financial
To
perspective?
provide a sufficient return on investment by increasing sales and maintaining the liquidity needed to support operations.
So which one was that one?
The first one.
First one, that's right. So to provide a sufficient return
Right.
on investment by increasing sales and maintaining the liquidity needed to support the operation. It's a good objective. Good objective. Now, we don't know what's in the middle here. We don't know what the objective function is. But that's certainly an objective. Now, how are we going to do this? By what performance measures? That's a good preposition used by what? By what performance measures are we going to be using in order to meet the objective? It's a good question. So by what performance measures will provide a sufficient return on investment by increasing sales and maintaining the liquidity needed to support the operations? You should have found three of them. Which are they?
Revenues for each type of insurance.
Yeah, so growth in revenues for each type of insurance would be one of the performance measures. Growth in revenue, I think that's a good one. What's another one that would likely fit in there?
Cash flow.
Cash flow analysis would be excellent. Cash flow analysis. What's a third one?
Percentage of new customers leads to results in sales.
Not bad, but not quite there. It could work, but not as well as one you don't know too much about. You probably had to say, this sounds right, because
return
it
on
sounds
assets.
financial. Which one is it?
Return on assets.
Return on assets. We'll talk about return on assets next week. All right, so good. Those are the three performance measures you would use to identify, or by what means would you use in order to move towards the objective. Again, the objective here is to provide a sufficient return on investment by increasing sales and maintaining the liquidity needed to support operations. And one of the ways you could do that is by growth in revenue of each type of insurance. That would be a nice little presentation. How do you do that? The Farmers Insurance Company, who has farmers who was interested in farmers? The Farmers Insurance Company was interested in that very issue. How do we do that? And the way they got at this, just for your own edification, is the agent was sitting in the back and he was really interested in how to make this a reality in his insurance practice. He was really stumbling on this one. So the team came up with front door cells and back room cells. And they framed the front room cells as people who have automobile insurance and sort of general over-the-counter, something a licensed individual could do at the front counter. But what he was missing on was what they defined as backroom cells. And the backroom cells is where another customer would not necessarily come to that front counter, but had some greater problem, a greater need for financial assistance that would reap greater revenue, right? So larger insurance, like life insurance, for example, whole life insurance, that kind of thing. And the team got at how can they target that reference group and get them to the back, get them to him, so that he doesn't have to worry about doing all the nitty-gritty automobile stuff, right? He can leave that to someone who's licensed to do that, and he can focus in on the big money stuff. And that's what they did was their presentation. How do you lay the office out? How do you do that internally to get at that objective so that backroom sales increase and therefore increase the bottom line? So those are great performance measures for the objective. What about learning and growth perspective? Did anybody get a chance to identify the objective in the performance measures? Learning and growth. Learning and growth is defined as the employee perspective, right? Mm-hmm. So this would have been all about employees.
Number of dollars spent on training?
Training.
So, first of all, let's identify the objective. What's the objective?
Oh, sorry.
Training employees.
Yeah, training should have been the one that tipped you off, right?
Right.
Training should have been the one that tipped you off that this is fitting in the learning and growth or the employee perspective, because you're gonna train employees, right? So that should have tipped you off. So to add value to the agency services by training employees to be knowledgeable and competent, what are some of the performance measures that would have followed that?
The percentage of employees who complete 40 hours of training.
That would be one of them, that's right. That would be an important construct, or how do you do this? By what method do you use to add value to the agency service by training employees? That's one. What is another one?
Number of dollars spent.
Spend on training, yeah, right. Let's put some bucks into the training program. Let's get some people in here who can, teach them how to do these kinds of things, how to be more knowledgeable and competent with the various kinds of products that we market in our insurance company. What's the third one?
Percentage of employees who complete 40 hours.
Right, we got that one. So we got that one, and we have number of dollars spent. What's the third one?
Average time for processing applications, insurance apps.
This is a difficult one because this is getting us to a different perspective, but not a bad choice. Think of another.
Number of new ideas?
Yeah, a number of new ideas for customer insurance, right? Why would that be? Why does that fit in the learning and growth?
Innovation.
Teaching people to be creative.
Yeah, that's
Thoughtful.
right. Right. Don't be limited in the scope of what you offer, but be thinking about how you can offer stuff outside the context of what you have as an agency. That's great. What about internal business? This is the more difficult one. I've been framing internal business perspective to you up to this point as marketing, as advertising, as branding, that kind of thing. Here's a different kind of perspective on the internal. So this had you think a little bit outside the box here. First of all, what do you think the objective was? What was the key term that should have unlocked this?
Efficient support
Efficient,
system.
cost effective.
For whom?
Customer agents.
Customers. This perspective is very much customer
Agents.
driven, right? So to operate efficient, effective office support. Office would have been a very key word in that because this is internal office support for systems for customer agents. What about the performance measures? What would you outline there for that?
Number of customer complaints.
So number of customer complaints, would that be internal or would that be customer perspective?
Because he just said.
Probably more aligned with customer perspective. Not a bad choice.
So average time for processing claims.
Yeah, average time for processing claims. Would that speak to efficiency? You ever go to a claims office, when you got an accident in your car and I don't know if it's taking you 2 or 3 days or just in time, immediate. That makes a big difference in terms of quality, in my view. What's another one? So average time of process, what's another one?
Percentage of revenue devoted to office staff.
Yeah, so percentage of revenue devoted to office support system, information systems, accounting, orders, claims, all that kind of stuff. And what's the third one?
Percentage of new customer leads?
Yeah, processing applications. Why is that internal? The faster you can process the application, right, the more efficient you are, more effective you are. Definitely an office, definitely an internal perspective. So here's a good example of doing something internally that's kind of like marketing and promoting, but it's moving towards efficiency with staff to generate more income, right? Yeah, I think you can see that. And then finally, the customer perspective. What's the objective, do you think?
It was the retained customers and
And attract new customers. Yeah, that was right on point. Everybody should have got that. And then what were the performance measures?
Average time for processing insurance applications.
Percentage of customers.
Wait a minute. Average time. That gets us back to the internal. Close. Back to the
Percentage
customer.
of customers who rate services is extra.
Every single word that every single performance measure that has the word what in it.
Customer.
Yes, get a clue here, right? Yeah, absolutely. So, percentage of customers who rate services excellent, that was one of them. Let's see. Percentage of new customers, customer leads that result in sales. Number of customer complaints, and percentage of customers who renew policies. Now listen to me. This is a very good example of the kinds of questions that you might ask and lead in your survey when you talk to your owners. These kinds of performance measures maybe of great value to you as you're sort of navigating through the question and answer time with your owners. How many, Mr. Owner, number of complaints do you usually get in a week? Well, now you know if that exists. We're dealing about what objective? We're dealing with the customer perspective, aren't we? Yeah. What's the average time, in this case for processing, but what's the average time for you to do a transaction sale? That's a good one. From the time someone comes to the counter to the time they say goodbye, how quick is that? What is your ATS? What's your average transaction sale? $1, $2, $5, $10. And if it's $6, how does that compare to peer analysis that might say $7 for the same business? What does that say? Does that speak to training? Does that speak to the ability to sell better and more effectively at the counter? Yes, it does, right? So these are great, these performance measures are great statements that can be framed in questions to get at unlocking what's going on in the business. I would use these if I were you. Note these. Okay, good. All right. Any questions on the balanced scorecard? This is your homework assignment for the week. It's not this one, it's another one like this. Just simply align what we did here with another company and you should be in pretty good shape for that. Okay, does that make sense? Now, you should have gotten telephone numbers, emails, all that kind of stuff from people in your group. And you should be collaborating with, about this time, businesses that you might get a hold of. Group over here.
Yes.
Do you have a business in mind that you're going to target?
We have 8 couple.
You have 8 businesses.
Well, we have a couple that we're like trying to figure it out.
We want to talk to them and see if they're receptive.
Okay, good. And do you know, listen up guys, in the back, listen up. This is for your own good. When are you going to contact these businesses?
Tomorrow I'm going to
Right away.
contact
So you got quite a few leads that can do that. You guys in the back, do you have a business in mind?
We have 3 or 4.
3 or 4, good. Business in mind?
Yeah.
Business in mind, yes or no? Couple?
Yes, and they already said yes.
Wow.
I don't play.
Gosh, you guys.
Got it. Okay. Number 2, you should come up with tonight, listen up group over here on my left. Listen up, you should come up with a fictitious name. That is your next task beginning now. Come up with your fictitious consultant name. Yes.
Our presentation's the very last night. I'm wondering for the owner to come.
Yes.
What time?
Yeah, we'll talk about that.
Team.
So come up with a fictitious name, some fun name, something that denotes who you are. Maybe the first letter of your last name combined into an acrostic, something like that. Come up with a fictitious name.
How about Moneymaker Consulting?
Dollar bill, yeah. Gonna make it rain.
Bucks Consulting, like the big bucks.
Soul.
ZXY. I'm just kidding. It's just that.
ZOL?
L.
LL?
ZOL. Zol. It's Dutch.
I'm trying to think. It's Dutch.
Just kidding.
Wait, John.
It's a family in New Zealand.
I heard that they were paying people to move to New Zealand. Now getting them jobs and all sorts of stuff because they live down in the South Island.
Is it too cold?
No,
Paying people to
they have
move to
more
New
jobs.
Zealand?
They have more jobs than they have people to work in New Zealand.
Really? Wow.
Yeah.
Beautiful there. It's
That's interesting because I've heard that they try to keep people out as much as possible because industry is doing well.
Yeah, my grandma was from Indonesia, and she was in a family that actually owned slaves in her family.
That's awesome.
And then they were put in a concentration camp by the Japanese.
That's also interesting.
And then the Americans came and saved them from the concentration camps.
And then the American enslaved them.
And no, and then she wanted to go to America because they saved her.
Ah,
I remember my
yes.
grandpa lived here. So I'm like second generation.
All right, do I have any examples of the fictitious names by anybody? Any group thus far? You guys
have a
over here
studio.
working on it?
Dude, look at the storm clouds that were moving into Minnesota.
Run for your lives.
Say that one more time. What is
Is that a
that?
tsunami?
No, it's just a.
J Squares Consulting. That is really cool though.
All right.
I mean, I probably like haven't slept for last night with that conversation.
That's all it's called. That works. Excellent.
That's it. Like that. I'm gonna die. Come on.
I mean, it was like, sorry, it's inappropriate, you guys. Clean up my
See, look, New Zealand town with too many jobs offering packages of land and homes for
Wait, I'm
165.
inappropriate. Why are you looking at this stuff?
Because I was talking about it.
MMC, Moneymakers Consulting.
What?
What do you think? Do you like that? Do you have a better idea? Because we don't have to have that. I mean,
No, it's fine.
most of the ideas that come out of my mouth are gold. Usually
We'll
the
just do
first
whatever
ones
you
are
want.
gold.
Well, why don't we just call it Kamari?
We call it Twisted Incorporated. I don't care.
TPK?
That actually sounds alright.
TPKC.
TPK Inc.
Consulting.
TPK Consulting.
With the awkward thing. I mean, let me do the thing. Okay. Okay. So you have a plan of who you want to interview.
All right, listen up.
You know
Listen
who
up.
you
So
want to
great.
interview.
I got a couple of very good examples of fictitious names. Group over here, what is it?
YKJ Squared Consulting.
YKJ Squared Consulting. Excellent.
SOS Consulting.
Very, very
Oh,
good.
nice.
Consulting, et cetera.
Consulting, etc. Excellent. You guys picked that one?
I think we're gonna stick with MMC.
Excellent.
Do you guys?
That's
Hi. What? Stay tuned.
We'll come back to you.
Stay tuned
Can we
consulting.
continue? Suspense.
I like stay tuned consulting.
To be announced, yeah.
Or figure it out consultant. Not my problem, it's your problem. Figure it out.
Solvent
See ya.
consultancy.
pretty good consulting.
They're pretty good consulting.
Ghostbusters.
Totally suck consultants.
Come in with
We're all
fun
students,
stuff.
She's like, make the push.
All right, we get crazy here, so. Okay, let's get back to where you normally sit.
Damn it.
Thinking cap back on, all right?
I just got.
Try to keep it
That does not bother. Wait.
I don't want it all, that's the problem. Celebrate mine, look at what I lost. In case you need financial and managerial, I've got them both. I texted them. Oh, here?
Wow.
No, I texted them with like, I think it'd be fun. Okay. No, just me.
Yeah, what's wrong with that?
It's financial
Oh,
and.
managerial.
So it's 1,300 pages.
Yeah.
I wrote myself a note. That's how I felt.
Okay, so for the weekend we have to solidify our questions that I can send to.
All right. Let's get into
tonight.
chapter 14 real fast, and then we're gonna
tomorrow.
get done here. Then if you want to get back in your groups, you can.
I've
gonna get out
primary. I need
sometime
to
tonight.
schedule the appointment. I'll send her a text right now. Well,
In chapter 14, a couple things I want to show you in chapter 14 that will be of value to you this week. Worth noting, and we begin this discussion on page 531 under the section titled Standards of Comparison. And this gets us at the idea of peer comparison or benchmarking. Page 531, Standards of Comparison, page 531, chapter 14 in your textbook. The section you're going to want to pay attention to this week when you do your studying is to take a look at industry norms. You see that right smack in the middle on page 531 under Standards of Comparison. Industry norms is using industry norms as a standard of comparison overcomes some of the limitations of comparing a company's measure over time. Industry norms show how a company compares with other companies in the same industry. For example, If a company, let's see, if companies in a particular industry have an average rate of return on investment of 8%, a 3 or 4% rate of return is probably not adequate. Using industry norms as a standard has some of the limitations that you can read during the course of the week in terms of compatibility differences and diversity. So, but that's what I'm talking about. Industry norms is all about benchmarking and peer comparison. That's the whole notion you see here. Past performance might be of a value. I may bring that up with you in your own group. If you can't find an industry to compare it to, then I'm going to show you how to extrapolate past performance to determine whether or not they're performing well. And I'll talk to you about how we do that. There's a methodology that we'll use to take a look at past performance. What did we do in the previous years to create a benchmark? But my hope is you don't have to use past performance. To the contrary, my hope is that you can find industry norms. How do you find them? What does that look like? You turn the page to 532 under the section titled Sources of Information. This is a good starting place for all of you to begin to get at resources wherein you can find benchmark material or peer comparison. There's lots of stuff that you see here, everything from Form 10K to Form 8K to Form 10Q to on page 533, business periodicals, including Moody's Investment Services, Standard & Poor's, Dun & Bradstreet. There's a lot of stuff under the sources of information here that can get you at peer comparison. SEC filings that you can pick up, publicly traded companies that do SEC filings where they have to file publicly their income statements and balance sheets and statements of cash flows. Those are all available to you. You can extrapolate off of those numbers. You can get a company that's doing something on a very large scale, that has lots of stores, and you can extrapolate using their total numbers divided by the number of stores to get at a per store average for all of the elements on an income statement. So some of you have spent a little bit of time studying SEC reports. With large companies that have lots of stores, you can break it down to a per store basis very easily by just spending a little bit of time doing some analysis. And that can get you at a peer comparison. You can do that with any industry that's publicly traded. And these are publicly traded information that you can pull off SEC filings. This section here talks about that. If you need some help with that, I can also be of assistance to you. But that's where we're going to get at that. There's two ways to benchmark them. One is to find information out there that's published that allows you to pull their data to compare the data of the company you're consulting with, and the other is past performance. How do we take the company's past performance, the previous 3 to 5 years, crunch the numbers there to determine what the benchmark is in the future? That make sense? And I'll show you how to do that, okay? So for now, I want you to err on the side of finding peer comparisons. I want you to rely on peer comparisons rather than past performance comparison. Okay, that makes sense? The other thing that you're going to want to get at in this chapter are 3 kinds of techniques of financial analysis. You'll find those techniques on pages 534 all the way over to pages 540. It's the reading that I've assigned you for this week, where you have things called horizontal analysis and trend analysis, vertical analysis. Those are 3 very good tools I'm getting at early on in this class so that you can use to get at analysis very fast. This week, your homework assignment will be for you to do very simple horizontal, vertical, and trend analysis. I expect you'll have absolutely no problems with that. What I want to show you, however, instead of how to do these problems, because you're fully capable, especially after last class, is to show you some great examples of what my expectations would be of graphs and pie charts. And this chapter does a good job demonstrating good graphs and good pie charts. For example, if you take a look at the chart titled Exhibit 5 on page 537, Exhibit 5 on page 537, that's an excellent, very succinct, quick graph that gets at operating income and revenues. There is a relationship between operating income and revenue. The relationship between operating income and revenue that I'm going to teach you next week is called profit margin. Remember I told you about that earlier? Remember I told you it's not gross margin? It's profit margin. And business owners and investors and people in business, and particularly a performance measure under financial that you would want to tap into is profit margin. This thing you see right here, this difference between the red line and the blue line, that difference between the red line and the blue line in 2009 and in the years before that, that's profit margin. So look at this. In 2005, how much profit was in their margin? Zip. But in 2009, they had a whole lot of profit margin. See the distinction between profit margin between the years. This is an excellent graph on a PowerPoint display that speaks profoundly to someone sitting in the back who needs to get at it quickly. And if profit margin's an issue, you pick up profit margin and you come right up here, and that's what you're going to be doing in the performance measure. How do we increase either revenue or decrease operating expenses in order to get at a good profit margin? Profit margin is operating income divided by revenue. That's what it is. Operating income divided by revenue. Now, profit margin is delineated very nicely in a very simple graph here that gets at both operating income and net revenues. This company, because it's net revenues, remember what I told you when they use the word net or net sales, net revenues? What did I tell you? It's a company that largely has what? Chargebacks, returns, right? It's a company that has a lot of returns. So this is net sales, this is net revenue and operating income. That relationship between the red line and the blue line is profit margin. It's a good example for you to be thinking about. If I'm going to do a PowerPoint and I want to show something with numbers and curvilinear lines, keep it simple. This is a great example. Nothing complicated, nice and simple. That's one. Number two, another good example of chart is those pie charts you see in Exhibit 6 and Exhibit 8, pages 538 and 539. Decent pie charts, nothing super complicated, nothing 3D, but to the point. And it gets at a couple of ideas that we'll be talking about in the future. So this chapter is full of good examples of sort of PowerPoint displays. All right. The analysis that I want you to pay particular attention to this week is vertical analysis. And I'm going to end on vertical analysis and then let you get in your group and go home tonight so that you're very comfortable with this. Trend analysis and horizontal analysis, you'll get at your homework assignment. I'll pick it up next week as tools that you might want to look at with respect to your company. But vertical analysis is something you're going to want to do immediately. So when you get your income statement, you're going to want to execute a vertical analysis approach. The vertical analysis is nothing more than taking one of the elements of the income statement and dividing it by the total. So, for example, revenue. So revenue, cost of goods sold, gross profit, margin, operating expenses, operating income, net income. Those are the elements. Those are the elements of an income statement. We know that, you're going to learn that, and you're going to get that. These are all the elements. And we know that this is taken away to get that. This is taken away to get that. And we also know that interest and tax expense is taken away to get that. We know that. Now, what vertical analysis does is that it assigns a percentage to total. So when you're given an income statement that has revenue of $100,000 and cost of goods at $50,000, that equals gross profit of $50,000 and operating expenses of $25,000. That equals operating income of $25,000 and interest expense and depreciation, that's $20,000. that equals net income of 5,000, or profit, net income, operating income, operating expenses, gross margin, revenue, and the cost of goods sold. When you have that, then what you can start doing is vertical analysis. And what vertical analysis is nothing more than taking the subtotal divided by the total. So example, gross margin, gross profit, vertical analysis says $50,000 divided by 1,000 is 50%. That is, gross margin, gross profit is 50% of revenue. Operating income, expenses is 25%. 25,000 divided by 100,000. Operating income is 25,000. 25,000 divided by 100,000 is 25%. And then 5,000 divided by 100,000 is 5%. Vertical analysis, cost of goods sold is 50%, and so on and so forth. Why is vertical analysis such a powerful tool in analysis as consultants? Why do you think that's a better tool than numbers?
You can very quickly see what
Very
Shows you where
size of
everything is.
chunk.
And more importantly, watch this, now if we have pure comparison, pure comparison, and the company we're consulting has, by way of national comparison, a gross margin that's 60% compared to 50%, what does that tell us?
They could improve.
By 10 points. And they need to either maximize this or minimize that. Does that make sense? Now you can begin to see how an income statement, analyzing it vertically and having pure comparison, can be very effectual, very fast at getting at whether or not you've got a financial perspective to deal with. Yes? Now you can come up with an objective, a performance measure and target, and speak very profoundly about what this company needs to do, either to maximize or minimize its issue. Likewise, net income down here is 5%. We would call that profit. Profit in the world, 5%. But if in the peer comparison, it's 5% over here, the peer comparison, we look at this as 10%, we can say to ourselves, wait a minute, the rest of the world's doing 10%, this company's doing 5%, we're likely got a 5% issue, and it's gonna be somewhere embedded in here. It is likely gonna be an issue right in the operating expenses. Minimizing or maximizing?
Minimizing.
Objective function is minimizing here, isn't it? Could be a combination between minimizing here and maximizing that in order for this to get maximized. Or more specifically, for this 5% to go to 10%. Does that make sense? That is why peer comparison is such a powerful indicator of not only you as consultants, but how to get at solving the problem, getting at not only the issue, but solving the problem. So what I want you to be thinking about when you get your income statement from your business owner, the first thing you'd be thinking about, some of you, is ask the question, have they analyzed it vertically or not? Most income statements have not been analyzed vertically. Most have not. Your textbook in this chapter shows some that have been analyzed vertically for Starbucks Coffee Company, but most of the ones you're going to get for most bookkeepers in this community, they will not be analyzed vertically. They will not have these percentages attached to them. Your task will be, somebody in your task will be to take the income statements and analyze them vertically. Get the percentages to it. Early on, get somebody else in your group. Delegate someone else in your group to find peer comparison. And early on, begin to put the black with blue early on so that within week 2 maximum, you have a pretty good idea by way of peer comparison what this company is or is not doing financially. Does that make sense?
Yeah.
So you think of your business when you were a cabinet furniture maker. One thing for you to do your income statement is show this vertically. Show the numbers in the vertical analysis. It's another thing to show this if all of the community in Reading was your peer comparison, and you knew in Reading, in your peer comparison, that its gross margin and its net income were these, what would that tell you as a cabinet furniture maker?
I'm out of business.
Well, it would tell you not so much you're out of business, but it could. But what it tells you is, I gotta make some adjustments somewhere if this norm is going on in my community, and therefore that adjustment may mean that you're gonna stay in business and not out of business.
That norm,
That's
something
right.
is out of-
You're moving towards best practices.
Yeah.
And pure comparison does that for you. That make sense?
Total sense. Total.
Yeah. All right. So that will be it tonight. Here's what I want you to be doing for the next 10, 15 minutes. You should be getting into your group talking about what you're gonna do this week. Who and delegating. Remember Dr. Tuckman's work in group formation. Storm informing, norming, performing, adjourning. Remember all that? Yeah, you do. Yeah, you do. That's
Storming?
way back in the past, that's right. And and you're gonna be going through that storming, norming, performing, adjourning stuff right now. So go through it at the moment, get that done, and figure out who's gonna delegate the performance part of the quotient.